Welcome, everyone. I'm Michael Thompson from Copperleaf Financial here in Vermont, and my guest today is Larry Swedroe, our friend and the Chief Research Officer at Buckingham Wealth, one of our most important partners in the work that we do. Larry is also on the investment committee for Buckingham Wealth and helps with the construction of our models that we use for all our client portfolios. So we're thrilled to have Larry here today, joining us to talk about mistakes that investors make in the market and a little bit about current situation in the market and the economy and things like that. Larry is also the co-author of one of my favorite books about retirement, Your Complete Guide to a Successful and Secure Retirement, which we had the pleasure of being able to write a little forward to, and we love sharing that book with our clients, along with a number of other books from Larry. Larry's authored 17 or 18 additional books. I can't even keep up anymore, Larry, with the number of books that you've authored.
Well, we're working on 3 more, Michael. So.
Oh my gosh! Well, someday maybe you'll have me add a chapter on sustainability or philanthropy or something. But
well, that's one of the new books, is on your complete guide or essential guide to sustainable investing. Hope to have that done out by the end of the year. We've finished 4 of the 6 chapters now.
Great. And I understand you're doing that with my friend Sam. So hopefully Sam's
that's right. Sam Adams of Vert Asset Management, X-Dimensional.
Yep. So welcome, Larry. Thanks for joining us. Let's get into our topic for today. And I wanted to start off with just an observation that it was a year ago, not a little bit more than a year ago, that we were facing a shutdown, really a global shutdown. Markets were down significantly. I don't remember how much. We were taking calls from clients about, oh my gosh, what should I do? And people were not thinking about investment opportunities so much. They were thinking about being afraid. Frankly, that was kind of the dominant fear. And then here we are today, a year later, and the S&P 500 is up for the year. The Russell 2000 is up significantly from a year ago. And what I'm experiencing, what I hear from clients, is exuberance, and the news is full of expansion and growth in the economy and opportunity. And, like a day like today where there's a little bit of fear about Johnson & Johnson, but in general, the climate is completely different than what it was a year ago. What does that teach us, Larry, about mistakes that investors make? What's your take on that, and what's a lesson that we can draw from that kind of historic context?
Yeah, well, there's lots of lessons, and we could spend a full hour just on this subject alone. But let's see if we could distill a few key points. First of all, if you look back, Michael, to let's say February, about mid-February of last year, there was nobody who was forecasting a global pandemic and stock market crashes. So that tells you something about the value of forecasts. And then there were people in April of last year or March of last year who were forecasting doom and gloom, and that 34% drop in the market, which was not the worst we've seen, but the single fastest drop of that magnitude over a period of about 5 weeks that we had ever seen, worse than anything in the Great Depression. And of course, there was no guarantee that we would get a vaccine this quickly and bring the economy out. In fact, there were many naysayers who said you wouldn't get a vaccine for 5 years. Right. So we were reading that. So another issue besides why you should ignore all forecasts, because the evidence says there are no good ones, is that your plan, when you develop it and you sit down with your clients, it must incorporate the certainty that we're going to have unpredictable events that are going to put stress on your portfolio. They happen about every 3 to 4 years or so when stocks underperform T-bills. And then we get a really severe crash. In the last 20 years or so, we've had 3 of them. So that in that period, once every 7 years. So your plan must incorporate that. And here's maybe the most important lesson. The vast, vast majority of investors are not economically rational. They are what we would call psychologically rational. They make decisions based upon emotions. And what can happen is we all know that the best thing to do, history says, when markets crash, listen to Warren Buffett and don't try to time the market, but if you can't resist, buy when everyone else is panic selling, because that's when prices are low, reflecting great fear. That means there's a big discount rate applied to the future expected earnings, and you can expect, but not a guarantee, to earn that high return. The highest returns to investors have always been right after big crashes. But yet most people tend to panic and sell. And that's because we're human beings, not robots. And there's great research, books like Jason Zweig's Your Money in Your Brain and others. Now psychologists have run tests and they watch how our brains react. And when we get into fear and panic and markets crash causing that, literally we get autonomic responses from the body. We start to sweat, our pupils dilate, we can't sleep, and these things cause us to panic. So the most important thing I think investors must do is, 1, ignore all forecasts. Number 2, build a plan that incorporates the certainty that you're going to live through many periods like this. The average 65-year-old is going to have second to die life expectancy close to 30 years now. There's almost a 50% chance, almost, that a 65-year-old normal healthy couple, one of them will live 30 years. So that means you have to plan 30 years. If we get the next 30 years look like the last 20, you're going to have to live through 4 more COVID-19 types of crashes, 9/11, 2008, that's the 3. And so build that into your plan and make sure you won't panic and sell when that happens, because you didn't exceed your risk tolerance or your ability or need to take risks, so that you're also able then to rebalance. Lots of people, even who don't panic and sell, don't rebalance, so they miss the opportunity to buy at low prices and therefore actually outperform their own portfolio allocation. If you were buying small value, for example, last March at the bottoms, you're up, depending upon the fund, something like 150, 160%. That's far outperform, but you wouldn't gain that much if you didn't buy more, right? So that's really the key. You have to understand you're a human being. You are subject to emotions like fear and panic. And so you have to build that into your plan, getting that right in the first place.
Yeah, we call it the certainty of uncertainty, and really planning for that along the way. And you're so right about the rebalancing. It's just dramatic what people are seeing in their portfolios now, when we were rebalancing last year at this time, and now rebalancing again. The gains, the profits in those portfolios is just remarkable. Again, not that we were market timing, we're just following the science and simply rebalancing when it's appropriate.
But Michael, that raises another great point that we should touch on.
Yeah.
What most people don't know is that the vast majority of returns occur in very short and therefore unpredictable bursts.
Yes.
One fund I happen to own, because I did some loss harvesting, I sold the Bridgeway small value fund. I bought the new Avantis ETF from the bottom until the high a couple of weeks ago or so, it was up 180% in 1 year. Now, the market was up less than 80, I think. So that's 100% small value premium. Now, we think over the very long term, that premium is about 3% a year.
Right.
So we got 33 years of an expected premium in 1 year, and you're only able to capture it if you're there and have faith in the long term. But here's another great example of why it's so key to stay disciplined. We looked at 100 years of data for the US markets. Mm-hmm. And if you took out the best 100 months, not the best month of each year, some years it may be 2 months and some years other months, but if you took out the other 100 months, now during this 100-year period, the market returned 10%. Michael, would you care to guess on behalf of your guests what the return on the other 1,100 of the 1,200 months was?
Wow. Well, it's got to be most of it, right? It's got to be most of that return for the period.
It's actually all of it. The return on the other 1,100 months was virtually zero.
Wow.
Now, nobody can predict which are the best 100 months. Of course, the reverse is true. If you could avoid the worst 100 months, that would be great. But there are no crystal balls that allow us to do that, which tells us that you shouldn't try to time the market. You have to be there like a deer hunter. You can't just show up at 7:03 and shoot the deer. You got to get there at 5 in the morning, sit there waiting patiently, and then you're able to capture the deer. And you have to have the ability to buy when everyone else is panic selling to capture those great returns. That's clearly what the evidence shows.
And along those same lines, Larry, it's also really fascinating to me the irrational exuberance in a way that I see from a lot of investors today, witness GameStop and some of these other phenomenon, and people really focused on what I think of as sort of the going to the bookie mentality of investing and trying to beat the market. And you see this during these periods of sort of increases and when the market's done really well. What does the evidence tell us about the ability of individual investors or even professionals to beat the market, to outperform the market in general? What does the evidence tell us about that?
Yeah, that's a really important issue because, again, it gets down to human psychology and our need to be part of the group and this fear of missing out, or FOMO, especially maybe even among younger investors, and also wanting to participate. And, there. What we know is this, that's how bubbles happen, because you get positive feedback loops. Something is doing well, and so it starts outperforming, and then people buy into it, and then stories start to get spun to explain it. This time it's different. Disruptive technologies. Cathie Wood's and ARK their funds, which were spectacularly successful, is a great example. So what I try to do is to provide the evidence showing that there is nothing new. There's nothing different. The only thing you don't know is the investment history you don't know. So I just wrote up a piece on this, will be published shortly, on this whole idea, because I'm getting lots of questions, as you are, about things like disruptive technologies. It's different.
Yep.
Well, the most famous person probably in history about disruptive technologies is a fellow named Clayton Christensen. Somebody today's investors probably never heard of. He sadly died recently. Twice he was named like the leading thinker about disrupting technologies in the world. He was a top professor, wrote many books on the subject, highly regarded, far more famous than Cathie Wood's. And so he wrote a book about this and then got the brilliant idea, why don't we start a mutual fund? And that was done in 98, right? In the dot-com era, which is the equivalent of, this era in a boom.
Yeah.
1 year later, it didn't even take a full year. I believe it was 11 months. He had burned through hundreds of millions of dollars. The fund collapsed and basically lost all investor money. I'll also point out that what we're seeing today is nothing more than a repeat of things that had occurred 3 other times. So 1920s, we had disruptive technologies. They were called the RCAs and the Westinghouses of the world. Airlines was going to change the world, etc. And we had a huge boom, and boom, that all blew up, and those stocks especially got crushed, and many of them didn't survive. And then, Michael, you and I are both old enough to remember the era of the Nifty 50 in the early 60s, when growth stocks far outperformed value, and companies like Xerox and Polaroid and Kodak and digital equipment and Data General were changing the world. I don't know if any young investors even heard of these companies, but they were all trading at PE multiples of 50 to 100 or more. Mm-hmm. And they all blew up. And the next 17 years, beginning in 66, the S&P underperformed T-bills for 17 years. And value stocks outperformed growth stocks by a cumulative, I think, something like 600 or 700%. So that blew up in investors' faces. It wasn't different. It was a repeat of the 20s. Then we had the bubble burst in the 90s. And what we're having is a repeat now. Now, we know this is likely true because we can look at the difference in returns between value stocks and growth stocks during the period of underperformance. So let me go back first to the 90s. Mm-hmm. If we start in March of 2000, growth, which had outperformed from 95 through 99 by so much that by March of 2000, growth had outperformed value over 1, 3, 5, 10, 15, and even 20 years.
Wow.
1 year later, the reverse was true. Again, showing you how quickly these things can turn around then. So growth dramatically underperformed. We had the biggest value premiums about in history over the next 8 years or so, from 2000 to 07, reversing that underperformance dramatically. And then there was kind of a horse race between growth and value, about pretty much equal returns in the US. Internationally, value still outperformed, but in the US, it was pretty much a horse race. No big winner one way or the other. But then from October of 2016 through March of 2020, period of only about 3.5 years, value got crushed in the biggest underperformance. Now, some people would say that's a regime change, and maybe it was. So now this disruptive technologies have much faster growth in earnings. But when we look at that, in small value stocks, there was no change in their relative profitability. In large stocks, there was a small difference that nowhere accounted for it. Almost all, actually, in fact, about 100% of the outperformance of growth stocks in that period was due to their PE ratios running way up, not earnings performance.
Right.
And we know that high PEs predict lower future returns. So that was a warning sign in showing that there really was nothing new. And we think value stocks are set to likely outperform. And that's what they tend to do when we have periods of stronger economic growth, rising inflation as well. And you get more normal risk premiums being restored. So we don't see anything different going on here at all. That's what history tells us. Just a lot of stories that don't hold up to examination.
And what's interesting, and actually I'm going to take a pause and remind people, I forgot to mention this in the beginning, we will have a question and answer session in about the last 15 minutes or so. So if you have questions, go ahead and you can put them in the Q&A section or in the chat, and we'll be taking those questions later on towards the end of our session. But Larry, part of what you just discovered or characterized for us might lead an investor to think, okay, I need to position my portfolio to take advantage of this, these shifts or these changes, things like that. But rationally, isn't there a better way than trying to predict what might happen in the markets? How might we encourage investors otherwise to use the data, to use the evidence, to position a portfolio to capture those returns when they show up? What's the best approach there?
Yeah, well, first of all, let's repeat the lesson I mentioned earlier, that there simply are no good forecasters. That's what the evidence shows, who can predict these, let's call them regime changes, from value to growth and vice versa, from US outperforming, which it did in the 90s and in the 10s, and international outperformed just as dramatically in the decades before and in between there. So if there was evidence of that, we should say we could be active managers or just simply trying to time based on valuations. Well, unfortunately, the evidence shows today that less than 2% of active managers are able to generate risk-adjusted outperformance. And that's even before taxes. So if you're a taxable investor, your odds are about 1 in 100 of being able to do that. And there's no evidence anyone has found a way to find that needle in the haystack ahead of time. So that's number one. The second point is investing needs to be thought of about always putting the odds in your favor.
Yeah.
Okay, because we don't have those clear crystal balls. So for example, we know that stocks have beaten T-bills over any period of time horizon we look at. But the longer the horizon, the more likely it is. So stocks outperform T-bills on a 1-year basis about 2/3 of the time. So 1/3 of the time they don't. Right. Over 5-year periods, it's more like 80%. At 10 years, more like 90%. And at 20 years, more like, call it 98% or 97%, something like that. But even at 20 years, you have to admit there's a chance that won't happen. Just ask Japanese investors who over the last 30 years have underperformed their equivalent of treasury bills. Right. The same thing is true of value stocks. They beat growth stocks about the same percentage that that stocks beat treasury bills, whether it's 1 year, 3, 5, 10, 15, or 20 years. I believe at 10 years, stocks beat bonds or T-bills about 90% of the time. Value beats growth 85% of the time. Mm-hmm. That's pretty close. Yeah. So do you want to try to time it? Or do you want to put the odds in your favor where you have an 85% likelihood? And by the way, I would add, today, I would say the odds are much greater than 85 because the historical spread between value and growth is much wider. By that, I mean, let's say historically, I'm just going to make this up, but the PE ratios are 1.5 times. So the PE of value might be 12 and the PE of growth might be 18. Well, today that spread might be 12 and 24. So that tells me growth is more expensive relative to value than historical. That means the odds are even better because the expected premium is larger. The same thing would be true. I think the odds of stocks beating T-bills over 10 years are much less than 90% now because stock PEs are so much higher than they were historically. So maybe it's not 90%, it's only 80 or 75, but that's still putting the odds in our favor. And the same thing is true of all the other investments we look at, things like buying small stocks or more profitable companies. We want to diversify our risks across as many of these unique risk factors, because any one of them can do poorly over very long periods of time. Let me give your listeners these data points. There are 3 periods of at least 13 years where the S&P underperformed totally riskless treasuries. 29 to 43, that's 15, 66 to 82, 17, and 2000 to 12 or 13. That's 45 of the last 91 years.
Wow.
That's telling you you don't want to put all your money in the large growth types of stocks that dominate the market. You want to spread your risk. And in those 3 periods, small and value stocks both outperform the market. So that's why we want to diversify. We're improving the odds of not getting that really bad outcome where everything crashes.
So here's another thing that I hear from people that's related to that, Larry, which is, okay, I should be perhaps allocating more of my portfolio to bonds or to what we would call fixed income. But gosh, interest rates are so darn low. You know, it used to be people would think they had a portfolio and they could live on the interest from their bonds or their CDs, and that would be fine. But now, all of a sudden, what's a 10-year treasury is paying, a little more than 1.5%, 1.6 or 1.7%. What's an investor to do, and how should investors think about that and avoid mistakes related to thinking that way?
Yeah, okay, that's really a great important question, and it's an issue we raised in our retirement book that you mentioned. We called it the 4 Horsemen of the Retirement Apocalypse. Investors are faced with the fact that, over the last about 40 years almost, a typical 60-40 portfolio got you about 10%. Over the last 100 years, it was more like 8.5%. But today, those bonds are going to get you, let's say, 1.5%. And we think stocks are more likely to get, call it 6 to 7 maybe, based upon their much higher valuations. So a 60-40 portfolio maybe gets you 4%. Right. And so that creates a big dilemma for a lot of investors. And that raise the issues of, what do I do? Well, the most important thing I will tell people is this: when you design your portfolio, it must include a sufficient amount of very safe bonds. That means only things that basically don't take any credit risk. So treasuries, FDIC insured CDs. If you're buying annuities that are state insured and you're in the limit, that's okay too. And if you're buying municipals, stick with AA and AAA municipal bonds that are also essential service or general obligation bonds. And the reason, and I don't care what rates are, you need to make sure that you have a sufficient amount to do 2 things. 1, so you can sleep well and enjoy life, because life's too short not to enjoy it. You also want to make sure you can avoid panic selling, because you say, oh my God, it's March 19th and the markets crashed 34%, and emerging markets international was worse and value was even worse. So now you're down 40% on your equities. And now you panic and sell because we don't know with certainty we're coming out of it. And then you can't ever recover because it's never safe, or it doesn't look like it's ever safe to buy again. And that 0 return even may be the highest return that you can get. The other reason why you want to have a sufficient amount of safe assets that people forget is if you buy riskier assets, things that people substitutes or treat them as substitute for safe bonds, things like dividend paying stocks and REITs and utilities and MLPs and all kinds of other things. they all crashed in the severe bear markets that we mentioned. In this recent panic, high yield bonds fell 30, 40, 50%. That same thing happened in the '08 crisis and 9/11. So you can't even rebalance, even if you don't panic and sell. You don't get that benefit. So rule one is have a sufficient amount of safe bonds, regardless of what interest rates are. Now, once you do that and you decide I'm willing to take some more incremental risk, then you can shift to assets that have higher expected returns, but without the volatility, downside risk of equities, because they're unique diversifiers that have different risks. So we recommend funds like a reinsurance fund. We use two to get some diversification. Pioneer runs one and Stonebridge run. They're both good diversifiers. Also, there are two fixed income funds that we recommend. One is called Cliffwater. They lend to middle markets. Their expected yield now or return is about 7%. And then Stonebridge's fund, Lendex, which lends to consumer small business, about 7%. Now, they do take some economic cycle risk because in an '08 crisis, we think those funds will lose about 8% or so based on the historical evidence. But that's nowhere near the 30, 40, 50% downside of stocks. On the other hand, we think they have about the same expected return of about 7%, but they don't get, in great years, they can't go up 20, 30, 40. They may go up 8, 9, or 10, but not 30 or 40. So you're narrowing the tails. And so that's really important. They're very conservative. They lend to only strong companies, low loan to values, so you avoid the downside risk. So for example, in the COVID crisis, unemployment hit 15%, but the unemployment rate for the people that this funds lend to was maybe a third of that. And the same thing is true to small businesses, middle market lending. The loan to value is only 50%. The historical evidence says the average default is only a 2%. And on that, they tend to recover 70% because of the low loan to value. So you lose 30% on 2%, that's 60 basis points. So even if that triples and you lose 2% instead of 60 basis points, you could see the impact. So those are things we look at, not going into things that really look like equities, but things that have different types of risk. So that's how we would address that problem.
And those are what we call the alternatives in our portfolios, and it's important to have them there as diversifiers and stick with it through the long run. We see that the performance there comes over time as the portfolio is working together. The other thing that I think is important, Larry, that we try to educate clients about and explain to them about is that in retirement, we take a total return approach to generating the income that they need and sustaining the portfolio over time, rather than depending on clipping coupons or the interest from those bonds. That's a different approach that it takes some education to help people understand sometimes, I think. I want to shift a little bit to inflation.
Michael, let's touch on that just for a second. There are a lot of people who use the cash flow approach. And to me, that is literally irrational. And the reasons are, number one, well, I only want to spend it. I don't want to touch my principal. I don't know about you, but I'm not living forever. And so there's no reason to not be willing to dip into principal from time to time if needed. You can't take it with you. So that's number one. But the second reason is it creates a real problem for investors when you get a low rate environment, because then they can't generate the income, and that pushes them to shift out of, say, safe CDs and buy dividend paying stocks, which maybe have a dividend of 3 or 4%, buy junk bonds, and then you get a crisis show up and their entire portfolio crashes, and now they end up eating cat food. That's the problem there. It literally makes no sense. And then you can't even rebalance the portfolio. You won't get that benefit because your safe bonds that you should have been holding typically go up, and you're able to sell them high and buy low. Now you have nothing to sell high because everything went down. So that's a real error.
It's such an important point, Larry, and helping people understand that principles there for a reason, and we can still grow and maintain a portfolio by smartly using that principle. I tell a story. I met years ago when I was first in this business. I met with a widow who literally was in tears. She was panicking because her husband, they only had CDs, and her husband had told her, never spend the principal, only spend the interest. And the CDs were renewing at such low rates that she didn't have enough money. And this poor woman was literally in tears at her kitchen table because she didn't have enough money from the interest from the CDs. And it took a while to help her learn that it was okay to spend some of the principal, and that we could figure out a way to help her. She had plenty of money, but she had to, we had to show her how to use the money that she had to live and enjoy life and not panic and be in tears because she didn't feel like she had.
Imagine the world, you're sitting in Europe and you have negative yields.
Yeah, right.
And so, the way to deal with this is that's why we run Monte Carlo simulations to show people what their odds of success. And before we invest, we always encourage that you have what we call a plan B that says, look, your plan, we don't want to be so conservative that your plan meets every possible bad scenario, because then you don't get to enjoy the fruits of your labor as much as you likely would. So we want to see success rates depending upon your flexibility. If you have a lot of flexibility to cut expenses because you're spending, for example, $300,000 a year, and you could easily cut it to $150,000 if needed, well, then a success rate of maybe 80% is enough because you can act dramatically. On the other hand, if you're a retired widow living alone, you don't own a car even, you don't have a lot of things you can cut, you may want to see a success rate in the high 90s.
Right.
But what we want to do then is to look at what are the steps you will take if that tail risk shows up, because we know, let's say you have an 85% chance of success, but the problem is if the day you retire, the markets crash, and that creates what we call sequence risk, what are the three things you're going to do? And in 2008, and again in this COVID crisis, we pulled out those plans Bs, and it said, we're going to skip the trip with talc to Europe this year, when, and might be to sell the second home or whatever the steps might be, move to a lower cost of living area. Don't buy a new car every 3 years. But those are the steps, so our clients weren't panicking because they had a plan that said, we know we will do these things. And then instead of that failure rate showing up, making those steps, again, raise that success rate to where they were comfortable.
Yeah, it's so important to help show people what their options are and have a plan ahead of time. Let's talk about inflation a little bit, Larry, because again, inflation is I think in some ways a hard concept for people to understand. I think a lot of times we get sort of anchored in the price of things today and forget that 20 or 30 years from now we're not going to be able to buy the same thing with the same dollar. But we are certainly in a low interest rate environment, but the news seems to be full of people saying, oh my gosh, inflation is on the horizon. And, government's spending like crazy, and that means we're going to be in hyperinflation. And What are your thoughts about inflation, and how do we apply kind of rational thinking and the evidence to helping our clients deal with inflation within their plan?
Well, again, we could probably spend an hour on this topic alone, but let's see if we can give a short, succinct answer here.
Yeah.
So we'll go back to one of my earlier statements about ignoring all forecasters. I'm sure, Michael, you and our listeners have all been hearing for the last 10 years, all these massive budget deficits and Fed printing money, and watching these commercials with the central banks printing money, we were going to see massive inflation, and it never happened. Japan is a great example of budget deficits and lack of necessarily a correlation with inflation. We are crossing the 100% debt to GDP, and that's causing people to be worried about inflation coming up. And Japan is over 250%, and they've been fighting deflation for the last 30 years. So it's not necessarily the case. And one reason is it depends on how people react to budget deficits and how governments act. So let me give you an example. Michael, you may have a lot of your clients are in retirement and maybe even well into it, but your younger clients especially are saying, hey, Social Security may not be there for me already. It's maybe not able to pay out more than 3/4 of what it's scheduled. I need to save more because the government won't be there, and that leads to much lower economic growth, suppresses demand, and you end up looking like Japan and Europe, who all have these problems of high budgets and deficits, et cetera. So one possible scenario is that all of this deficit spending leads to a decline in what's called the velocity of money, and people just don't spend. Now, I will add, this is exactly why inflation, or one of the main reasons why we haven't seen inflation in the last 20 years or so, is despite the rise in the deficits and the printing of money, if you will, this helicopter money, because the Fed is buying up the debt. So the money supply has actually grown at 8% a year. And that with about 2% growth in GNP, that would, some people would say, should lead to about 6% inflation. That's the difference there. The reason we haven't seen that is the velocity of money has collapsed from about 2, so every dollar was spent about twice a year, down to about 1.1, which means about 45% of the increase of money supply was offset by a decline as people started to save more. Savings rates went way up and people didn't spend. So let me point out this. All the economists who people here are worried about inflation, I agree, that's a risk. We could end up looking like Argentina or Brazil or other countries in the past. If we see people start to worry about inflation, start to spend quickly, we get the rapid growth in the economy and it picks up and everyone gets exuberant, stops worrying about, and the velocity picks up. And if the Fed doesn't unwind all of what it did and start to sell back those bonds and drive interest rates back up, we will get inflation with certainty. But that's only one possible scenario. Another scenario is the Japanese scenario. And the third one is we somehow muddle through and get through this grand experiment, and the Fed is able to execute perfectly well, and we get low inflation and back to normal economic growth. So one scenario is we look like we get an outcome like the guns and butter from the 60s, when we tried to keep the economy going, fight the war in Vietnam, but not pay for it and raise taxes, just like we're not doing today. We're just spending money. And we ended up with inflation rising from under 2% to up to double digits by the late 70s, early 80s. People have to understand that is one possible outcome. Now, don't let your personal biases overweight that, My guess is Republicans probably are doing that. It is certainly a risk, and your plan needs to consider it. So we don't want to own a lot of long-term bonds, and that's one of the benefits of the alternative fixed income funds we do. They're all either very short-term loans and or floating rate loans. So very little to no inflation risk there. Another risk is another possible scenario is the Japan, and interest rates end up looking more like Japan and Germany with even negative rates. And the third is we get back to more normal rates. So you get 2% GNP growth, 2% inflation, and we get interest rates then in the 4 to 4.5% range. You know, my naive way of thinking about it would say maybe there's a 1/3 chance of each. Everyone can put their own odds on, but you should always consider all of those. That's what we do when we run Monte Carlos, and we make sure our plans can adapt to any of them.
Again, the planning for the certainty of uncertainty, we incorporate that into the math, into the analysis.
And Michael, again, I want to emphasize, that's why I really like Lendex and Cliff Waters Fund, because you're getting big risk premiums without taking too much economic cycle risk. You're getting paid a lot to give up liquidity, but I don't know any of our clients who are taking more than their required minimum distribution. And you can always get, 20% of your money back in any 1 year anyway. So that's okay. And for some portion of your portfolio, you can own illiquid assets and capture that premium in the same way the Harvards or the Yales do. So that allows us to get higher returns without taking much economic risk, so not a lot of credit risk, but some.
Yep.
And we're actually reducing inflation risk because we're moving away from the typical 4 to 5 year types of bonds we might own down to basically 1 year or less. Yeah. And so a little bit more credit risk, but a lot less inflation risk. So let's say those two about offset each other, and you're picking up about a 6% extra return. To me, that's a good trade-off.
We like the diversification. We like how those alternatives really, like I said, really complement the rest of the portfolio. I'm going to open a little can of worms here, Larry, and I'm going to ask you about crypto. So right. It's in all the news and everywhere. And what's your thinking about digital currency and this crypto craze that's going on right now?
All right. Well, let's first of all, I wrote a paper on this subject back in 2017. So, Michael, you can share that with your clients. None of my thoughts have really changed. So let's bifurcate the conversation into the technology of blockchain, which is what's behind crypto. And that is a dramatic improvement for the world, for everything, including our financial system. Think how insane world we live in today, that I can't move money from bank A to bank B unless I pay a $20 wire fee to get it there the next day. If I do an ACH transfer, it could show up 3 days later, and then the other bank can say, well, I won't let you cash that money for 5 days.
It's crazy.
With blockchain technology cryptos that use this, in theory, could move money from Zimbabwe to Rhodesia or anywhere in the world and get access to that money instantaneously and a fairly cheap. So my personal guess is that within the next several years, you will see cryptocurrencies or digital currencies everywhere in the world, including the United States, will have a digital currency. Mm-hmm. So that's number one. That will enable faster movement of money. And think about all the benefits that brings to people in the world who don't have the safety and security of a banking system, like in Africa and the rest of the world. I think so that's number one. On the Bitcoin side, here is where I have a problem. So I can't find any logic literally for Bitcoin itself. I feel good in the sense that, in my opinion, the best financial economist we have, John Cochran, has espouse the same views that I have had. I am a trained economist as well. And while the technology is great, there may in theory be a limited number or supply of Bitcoins. That's the way it's designed. There is an unlimited supply of Bitcoin alternatives. There are thousands of them out there, and I can't explain or think of a reason why anyone should prefer Bitcoin over another one. And if you have an unlimited supply of something, that tells me the price should asymptotically go to zero, especially if the alternatives give me the same speed and access and everything else that it does. And I would worry about central banks saying we're going to lose control of the money supply. So now I would add also, this one has an interesting twist on it, but most people are probably unaware that the blockchain technology is incredibly energy inefficient.
Oh, it's horrible.
Already today, we are using more energy than most of the countries of the world by number of countries. And that is obviously energy inefficient. Now, the theory though is you could move the energy creation to anywhere in the world where it's cheap, and the Bitcoin miners would pay for the development of wind farms and other things, but that could be way down the road. So there is even the risk of some ecological issues. I'm not going to make that case because I think you could argue the other side. But to me, unless I could put a value on something, and there is no cash flow value, there's no earnings, etc. And here's the last thing I'll say. Gold might be, Bitcoin you might think of as an alternative to gold maybe,
right.
But there is at least limited supply of gold to some degree. Right. But gold has provided a zero rate of return for over 2,000 years. So the story goes when Jesus walked the earth, an ounce of gold bought a good suit of clothes, and that's about what it buys today. Right. I don't want to put any of my money in something that is likely to have a zero rate of return. So I'd rather invest in things that I can have an expectation of rate of return, and there's logic behind it. Now, could I be absolutely wrong? And everyone Bitcoin depends upon people's beliefs. And if they believe, the value will go up. And if people find that there's there's not a reason to believe, it could go to zero. My crystal ball is cloudy on that one.
Yeah, mine too. Well, I'm not seeing any questions. If anybody has them from the audience, please go ahead and post them. Larry, I guess I will ask you if you have any final thoughts about either the markets or the economy that you would want to share with our audience today with respect to kind of their future planning or their investing in general.
Yeah, I would offer these words of caution. We tend to have very short-term memories. We're subject to recency as investors, and we project what happened in the recent past into the future, into infinity, rather than look at the historical evidence, which says that when things get popular, trades get crowded and those assets become expensive, and we tend to see mean reversion and bubbles burst. They always have. It's just impossible to predict when. A great example of that was in late 96, I believe it was, Alan Greenspan coined the phrase irrational exuberance, causing people to panic. When the PEs of the stocks were in the low 20s, he thought the market was too high. Turned out he was right, just he was about 3 years too early. So you can't time these things. But eventually bubbles do burst, but they can get a lot bigger. The best thing to do is just avoid them in the first place. Ignore recent performance. Look at 100 years of data, what that tells you, and then construct a portfolio that puts the odds in your favor. And if anything, if you're going to be tempted to what I would call sin by trying to time the market, one, buy what is done poorly recently because it's now cheap, and only sin a little. So what do I mean by that? So I believe the starting point for, or at least a good starting point for your equity allocation is the way the world allocates capital. So 50% US, about, call it 3/8 international and 1/8 emerging markets. Well, the US has dramatically outperformed for the last decade. So if I'm going to do anything, I don't want to own more US. I want to own less, but I might lower that to 45% and put that 5%. And that's about all the sinning that I think is prudent. And then if it underperforms, it didn't cost you that much. And if it outperforms, then you say, thank you. And now let's go back and do the reverse again. But the evidence is very clear. Trying to time things based on valuations is not a good strategy because so much of the returns happen in very short periods that it's impossible to capture them. You're better off having a plan and sticking with it. So that's my advice. Develop a plan, work with Michael, whatever you decide is the right strategy for you. If you want to own less emerging markets, because whatever the reasons, and you say, all right, let's own 10% instead of 12, I'm okay with that, but then live with it because it's far more important to stick with whatever strategy you choose than to find the quote perfect portfolio. There is no such thing.
Exactly. Well, and we're so thankful to be able to have your thought leadership, Larry, in helping us examine this research, be current on the latest thinking from the academic world, and being able to apply that to our clients' planning and portfolios in ways that allows people to sleep at night, and frankly allows me to sleep at night on behalf of our clients. Knowing that we've got a good plan in place, we're planning for the certainty of uncertainty, and we're putting people in the best position to have a successful retirement, to achieve their objectives, and not be subject to the whims and the whipsaws of trying to guess what's going to happen in the market and things like that. So thank you, Larry, for your leadership and for your help today. And as always, we appreciate it. If we have listeners that don't happen to have a copy of Larry's book, Your Complete Guide to a Successful and Secure Retirement, I'd love to send you a copy and provide a copy if we haven't already, because again, my favorite book about retirement by far. Larry, thanks so much for your time today. And I hope to see you again soon. And maybe one day once we're all fully vaccinated and we can travel again, I'll see you at a conference, or I'll see you face to face.
Well, thank you. Enjoyed being here, and we'll do it again.
Yep. Thanks, everybody.